I'm Monica from Numberly. So today I wanted to talk to you about a concept called internal rate of return, or IRR. And the reason that this is important is because it gives an investor, from a conceptual standpoint, what it is the idea of how much is my return, my expected return, if I give you money and I invest in your startup today. And when we calculate it, it's based on the valuation of the company, the share of their ownership, the dividends that they will receive or expect to receive over time, and the share of their exit. So all of these factors go into how we calculate the IRR. So if we walk through a concrete example, let's say that the valuation of your startup is already known. It's 7.5 because you've done a financial model and you put in your projections. And this is what the model tells you your valuation is. If you'd like a refresher on how to calculate the DCF, you can watch the other video in the series called DCF Valuation. So we already know that the valuation of our startup is 7.5. And now we can start thinking about the two different ways that the investor gets paid and use those to come up with the IRR, or internal rate of return, of their investment. So the first way that they're going to get paid is the dividends that we will pay out based on the profits that the business generates. So let's say, for example, that the dividend payout ratio is 80%. This means that these numbers are 80% of the profits that we will generate every year. This is for all investors. We haven't yet come to the share, the 12% share based on the million that this particular investor has invested. We'll come to that in a second. Next, let's look at the potential exit value, and let's say that we're using a 6 times revenue multiple to calculate the exit value. And this is going to be something that's going to be determined by the comparables in your space and what other potential startups are exiting at. What is their revenue multiple? And so if we assume, for now, for the sake of argument, that it's 6 times, we can then say that this is the revenue multiple for each of the years. And if we then assume that we exit in 2028, now we have all of the ingredients to be able to calculate the IRR. So first, this investor has given $1 million against a valuation of 7.5. As we said, that's 12% ownership. And if that is the only investment that they make in the company, their total equity ownership stays at 12%. And now we can circle back and say that of the amount that we have paid out in dividends based on this 80% dividend payout ratio, this is the investor's share, which is 12%, their ownership of all of the dividends that we're going to pay out. In addition, the second way that they get paid is at the exit, which is, we've said, going to happen in 2028, we hope. And we use this revenue multiple to come up with the exit value. This is their share of the exit value. If we add up then all of these cash flows, including the $1 million they give us today, plus the positive dividends that they receive over time, plus their share of the exit, we can use all of those to throw it into an Excel formula, which is IRR, and we can come up with the internal rate of return pretty easily. And in this particular case, it turns out to be 39%. So above that 30% threshold that we were looking for. And it gives both you and the investor a sense of what is the potential return on my $1 million investment into this startup. I hope that's helpful. If you have any questions, please go to numberly.io and the chatbot on the lower right. We'd love to hear from you. Thanks very much.